This question is obtained from Kaplan ACCA study test. So we have the question. Neville is a company that manufactures and retails office products. Their summarized financial statements for the year ended 30 June 20X4 and 20X5 are given below. Statement of profit or loss for the year ended 30 June. You have for 20X4 and 20X5. All figures are in thousands. We have revenue, cost of sales, gross profit. We have operating expenses, profit from operations, finance costs, profit before tax. We have tax, then profit for the year. We equally have statement of financial position as at 30 June. We have 20X4 and 20X5. All figures are in thousands as well. We have non-current assets. We have current assets. We have inventories. We have receivables. We have bank. Then we have share capital, share premium, revaluation reserves, retained earnings. We have non-current liabilities. We have current liabilities. We have payables. We have overdraft. Then we have tax. Then the total. The directors concluded that their revenue for the year ended 30 June 20X4 fell below budget and introduced measures in the year end 30 June 20X5 to improve the situation. This included cutting prices, extending credit facilities to customers, leasing additional machinery in order to be able to manufacture more products. The directors are now reviewing the results for the year ended 30 June 20X5 and have asked for your advice as an external business consultant as to whether or not the above strategies have been successful. Required. Prepare a report to the directors of Neville assessing the performance and position of the company in the year ended 30 June 20X5. Compared to the previous year, and advise them on whether or not you believe that their strategies have been successful. So that is the questions. In this question, we are going to write a report. But before we start with the report, we are going to analyze the financial statements. On the basis of the information obtained from our analysis, then we are going to report on them. Then after the analysis, I will give you a comprehensive report. Please subscribe to this YouTube channel to keep up with my video lectures, as it will be added from time to time. So my lectures will cover, I will still extend to other courses later. So, but just try to subscribe to keep up with the contents. So, now, I want to start with the ratio showing the performance. The performance ratios are majorly the profitability ratios. So I want to start with the profitability ratios. So now, appendix to the report. Appendix to the report. Now, number one profitability ratio we are going to look at is the gross profit margin, and which is gross profit over revenue times 100 over 1. That is the gross profit margin. Gross profit over revenue. We have for 20x5. We equally have for 20x4. The gross profit for 20x4 is 406,400. And this is the gross profit over revenue is 1,159,850. So to compute the gross profit margin, so we have gross profit margin. The gross profit for 20x4 is 406,400 over, let me add k because 3 zeros are being eliminated. 406,400 over revenue 1159,850. Okay, I'm adding k because the 3 zeros at the top to cover that. Then for 20x5, the gross profit is 340,995. 340,995 over the revenue for 20x5, 139,820. 139,820 times 100. Therefore, gross profit margin for 20x4, you have 406,400 divided by 1,159,850, 1,159,810 times 100, and that is 35.0% to 1 decimal place. For 20x5, you have 340,995. 340,995 divided by 1,391,820. 1,391,820. And that will give us, when you multiply by 100, to give us 24.5%. You have to be consistent with your rounding. Then number 2, we have operating profit margin. This is performance ratio. Performance ratios. Then operating profit margin, which is the same as operating profit margin is operating profit over revenue. Operating profit is the profit before interest and tax. Profit before interest and tax. PBIT means profit before interest and tax over revenue. Or you can call it operating profit over revenue. So we have 20x4 and 20x5. You have been given the operating profit where the operating profit is not given, because you are given profit from operations, where it is not given because you may be given profit before tax. You take your profit before tax, you add your finance cost. I've told you that our finance costs are interest-related item. So the profit from operation 20x4 is 235,450. That is operating profit margin. Operating profit margin. So operating profit 235,450. 235,450 over revenue. Revenue is still the same as 1159,850 times 100. Then for 20x5, operating profit is 179,545. 179,545. 179,545 over revenue, which is still the same as 139,1,820 times 100. So, when you divide that, therefore, operating profit margin will be, for 20x4, we have 235,450 divided by 1159,850 times 100 to give us 20.3%. 20.3%. Then for 20x5, 179,545 divided by 139,1,820, and that will give us times 100. That will give us 12.9%. 12.9%. Number 3, you can have expenses ratio. Expenses ratio, which is operating expenses, over revenue times 100. This will also provide additional information for interpretations. So that is why I'm adding that as one of the performance ratio. Operating expenses, 20x4. Operating expenses, 170,950. Expenses ratio, 20x5. Operating expenses is 170,950K over revenue. Revenue still remains the same, 1159,850K times 100 over 1. For 20x5, operating expenses is 161,450. 161,450K over revenue, which is 139,1,820K times 100. So which is 170,950 divided by 1159,850. And that will give us times 100. That will give us 14.7%. Therefore, expenses ratio will be 14.7% in 20x4. In 20x5, we have 161,450 divided by 139,1,820 times 100, and that will give us 11.6%. 11.6%. 11.6%. So, number 4, we have number 4, ROCE, return on capital employed. Return on capital employed, which is the primary ratio. We said that is profit before interest and tax over capital employed. Profit before interest and tax over capital employed times 100 over 1. So we still have 20x4 and 20x5 in order. So return on capital employed, return on capital employed, ROCE. Return on capital employed, ROCE. Then we have the profit before interest and tax. Profit before interest and tax, which is still the same as profit before operation because tax have not been deducted. But where you are not given profit before profit from operation, you take your profit before tax, you add your finance cost. So profit before interest and tax is 235,450. So our rules is 235,450K, 450K over the capital employed. I've told you that capital employed is equity plus the fixed interest, debt. Equity plus fixed interest, debt. So, but we are not given the fixed interest debt, but you are given non-current liabilities. I want to assume that these current liabilities, these non-current liabilities are fixed interest. That is why I'm going to add it. So if you choose to use the equity alone and ignore this, you will still be mad, right? So that will be 407, 407, 420, which is our equity, plus the fixed interest, 83,100. 83,100. I'm assuming that as fixed interest debt because we have finance cost, and interest will be paid on the finance cost on the fixed interest debt. So that is why I'm assuming this figure to be fixed interest. 546 rows for 20x5. Rows profit before interest and tax, which is profit from operation, and that is 179. 545 over capital employed, which is equity 546 165. 546 165 plus the fixed interest debt 161 600. 161 600. 161 600 times 100 over 1. So for 20x4, rows will be, we have 235 450 divided by the sum of the denominator 407 420 plus 83 100 times 100. You have rows to be 48.0%. For 20x5, we have 179 545 divided by 546 165. 165 546 165 plus 161 600 times 100, and that will give us 25.4%. That is the ratios. That is the ratios showing the performance. Then we want to look at the liquidity ratios. Liquidity ratios. Those ratios that can be used to measure the liquidity. They are majorly current ratios. And our current ratio is current assets over current liabilities. Current ratios. Current ratios, which is current assets over current liabilities. Current assets over current liabilities. In 20x4, current asset is the total of this. And in 20x5, current asset will be the total of this. So, when you sum up that, addition of the three, Total current asset is 390. Current ratio 390,710 over current liabilities. Our current liabilities will be the addition of this. Current liabilities will be the addition of this. So which is 179,590 plus tax of 62,000. So current liabilities will be 241,590. Then for 20x5, current assets, addition of this, 109,400 plus 419,455. Current assets totaled 528,855. 528,855 over current liabilities. Our current liability total. Current liabilities, addition of the three items, 295,480. Current liabilities, 295,480 plus 80,200 plus 55,000. The total of current liability is 430,680. Therefore, current ratio 390,710 divided by 241,590 to give us ratio of 1.6:1. For 20x5, you have 528,855 divided by 430,680, and that will give us ratio of 1.2:1. Another ratio that can be used to measure the liquidity position of the business is quick ratio. Quick ratio or acid test ratios. Quick ratios or acid test ratio, which is current assets less inventories over current liabilities. Current assets less inventories over current liabilities. That's why we call it quick acid test ratio. Acid test ratio or liquid ratio. So the current assets has been calculated. The current assets has been calculated to be 390,710. Okay, less inventories. Inventory in 20x4 is 88,760. 88 inventory, 88,760. So you subtract that. 88,760K over current liabilities. Our current liability has been calculated to be 241,590. Then for 20x5, the current assets remain as 528,855. 855K minus inventory. $528,855K less inventory. Inventory is 20x5 is 109,400. 109,400. So 109,400K over current liabilities, which remain as 430,680. Therefore, our quick ratio will be, when you divide 390,710 divided by minus 88,760 divided by 241,590, and that will give us 1.2 to 1. For 20x5, we have 528,855 minus 109,400 divided by 430,680, and that will give us 0. Okay, if you take it to whole number, 1.0 to 1. Number 3. You can also use receivable collection period to measure the level of liquidity. Receivable collection period. You want to ascertain how long the receivable will be realized. How long will it take you to convert your receivables to cash? That is receivable collection period. How long will your receivable, that is, will your debtors pay you? So that is receivable over credit sales or credit revenue times 365 days in a year. Receivables over credit revenue times 365. For this ratio, you will want your receivables to be realized on time. You want to convert your receivables to cash on time. Therefore, you will prefer the lower. You will want it to reduce so that more cash will be able to come into the firm on time. So, please make sure you watch the explanations, the previous explanation I've given on this topic, interpretations of financial statement. And ensure you subscribe to my channel. Keep up with the videos, as it will be added to this channel from time to time. So, receivable collection period, which is your receivables over credit revenue. Your receivables for 20x4 is 206, that is receivable collection period. 20x4, we have receivables of 206,550 over your credit sales, where you are not given credit sales. You assume that all the sales are on credit. No, all our revenue are on credit. For 20x4, we have 1159850. 1159850 times 365 days. And for 20x5, receivables is 419 419 455 455 over revenue. Our revenue or sales, I've told you that it should be assumed to be on credit, which is 1391820. So it's ought to be obtained from the questions on the board, but I've rubbed off the statement of profit or loss. That is why I'm going back to the solution to look for our revenue. So our revenue is 1391820 times 365 days. Therefore, receivable, collection, period. I've explained how to interpret, though we are going to report. We are going to interpret this by writing a comprehensive report. 206 550 times 365 divided by 1159 850. That will give us 65 days. 65 days. Then, for this, for 20x5, we have 419 455 divided by 1391 820 times 365. And that is 110 days, which is very bad for the company, for the increase, because of the increase. It's very bad. It means their receivables are not, well, they are not easily realized. Receivables are not easily realized. It cannot be converted to cash easily. So when we are reporting on it, so I will explain it better. So we also have creditors' payment period. Creditors or payable, let me use payable. Payable payment periods. These ratios I've told you, it explains how long the suppliers will be paid. And I've told you the consequence. Normally you will want it to increase. You will want the higher. The organization will prefer the higher one. But the suppliers will prefer the lower one. Because if your suppliers cannot be realized easily, they will not want to extend credit to you. So that will be payables over credit purchases times 365. I've told you your purchases are not given, so you can use your cost of sales. Your cost of sales can be used in place of the purchases. You can use cost of sales in place of the purchases, or you add the closing inventory and less the opening inventory to get the purchase. The payables figure under current liabilities for 20x4 is 179,590. So 179,590 over, I'm using cost of sales since purchases figure is not given. Cost of sales, even though you can work it back to get purchases for 20x4, you cannot be able to work back that for 20x4 because you cannot get the opening inventory. Even if you work it, it will not be right. It will not be, the figure you can obtain will not be comparable. So using cost of sales. Cost of sales for 20x4 is 753,450. 753,450. 753,450 times 365. That is for 20x4. The 20x5 cost of sales. Cost of sales for 20x5. We have the payables. Payables for 20x5 is 295,480. 295,480 over the cost of sales for 20x5, and that is 1,050,825. 1,050,825 times 365. So, payable, payment, period. I've told you if it is too high, your suppliers will not be willing to extend credit to you. 179,590 divided by 753,450, and that will give us times 365, and that will give us 87 days. 87 days. Therefore, payable, payment, period is 87 days. For 20x5, we have 295,480 divided by 1,050,825 times 365, and that will give us 103 days. 103 days. That is payable, payment, period. Payable, payment, period. So we can also have cash ratio, which can as well be used to measure the liquidity position. Cash ratio, which is cash or cash equivalent. I don't think we have a cash in 20x4, but we have about that in 20x5. So let me leave it out. Cash ratios. So then, remember, you have to prepare a report assessing the performance and positions of the company. So the third section is the GRE ratios. What are GRE? So we have fixed interest loans. Fixed interest loans over capital employed. Fixed interest loans. Fixed interest loans or debt. So GRE equal to fixed interest debt or fixed interest loans over capital employed. Fixed interest loan or fixed interest debt over capital employed. That is GRE. For 20x5, I told you earlier that I was assuming this non-current liability to be fixed interest, though the coupon rate is not given. I'm not given the coupon rate of the non-current liabilities, but I'm still assuming it because of the finance costs are given in the statement of profit or loss. So I'm using the non-current liability. So GRE, which is 83,100 over capital employed. I've told you that I was using the sum equity plus the fixed interest loan, which we have used when we were calculating the rows. So that is what we used. So let's sum it up. So 407, 420 plus 83,100. And that will give us 490,520. So multiply by 100. For 20x5, the fixed interest loans is 161, 161, 600 over equity, which is 546,165 times 100. Sorry, this one, you also sum it up to allow room for comparison. 546,165 plus 161,600, and that will give us 707,765. Then, therefore, our gearing will be 83,100 divided by 490, 520 times 100, that will give us 16.9%. For 20x5, we have 161,600 divided by 707,765 times 100. That will give us 22.8%. Then we have fixed interest cover, or interest cover. Interest cover. Interest cover. So we have profit before interest and tax over finance costs. So from the statement of profit or loss, we have interest cover. From the statement of profit or loss, our profit before interest and tax, which is the same as the profit from operation, 235,450. 235,450. That is the profit before interest and tax. There is a mistake in the question. I copied the question wrongly. Here, where you have 161,600, it is 61,600. So meaning that the only figure affected in my solution is where I use capital employed for 20x5 alone. 20x4 would be correct, but 20x5, where you have return on capital employed for 20x5, it will be affected because I use 161,600 instead of 61,600. So you can correct that. Then where I equally have gearing for 20x5, 20x6 will be correct, 20x5 will be affected because capital employed here is wrong, and even this figure is supposed to be 61,600. So apart from that, every other informations are correct. So interest cover, profit before interest and tax over capital employed. Over finance cost. Finance cost, that is the interest from the statement of profit or loss. For 20x4, we have 14,000. 14,000. Then the profit before interest and tax for 20x5, we have 179,545. That is profit from operation, 179,545. 179,545 over finance costs for 20x5, and that is 10,000. 10,000. Therefore, interest cover, and that is 235,450 divided by 14,000, and that will give us 16.8%. 16.8%. For 20x5, 179,545 divided by 10,000, and that will give us 18.0%, and that is the interest cover. Now, you can as well add the trend for your revenue, your cost of sales, and gross profit. So we have revenue. We still have 20x4 and 20x5. We have revenue for 20x5. Revenue for 20x4 is 1,159,850. 11,850. For 20x5, revenue is 1,391,820. 1,391,820. And there is percentage change. What is the difference between the two figures? 1,391,820 minus 1,159,850. 1,159,850. There's a difference of 231,970. You now divide it by that of the base year. The base year is 20x4 divided by 1,159,850 times 100. The percentage change is 20% increase. So that's why I'm putting it as positive, 20%. The cost of sales. Cost of sales. The cost of sales for 20x4 is 753,450. 753,450. That of 20x5, the cost of sales for 20x5, and that is 1,050,825. So the cost of sales increases by 1,050,825 minus 753,450. So divided by that of the base year, 753,450 times 100. That is 39.5%. So it's also an increase. Then the gross profit. Gross profit. Gross profit for 20x4 is 406,400. 406,400. And the gross profit for 20x5, that of 20x5 is 340,995. 340,995. 340,995. So we have 406,400 minus 340,995 divided by that of the base year, which is 406,400 times 100. This one is a decrease of 16.1%. 16.1% decrease. So have we analyzed the appendices to the question or to our report? So we can now write a comprehensive report on the case. So, report. You have to the directors of Nevi from the business consultant, from business consultant. Date. 31st July 20XX. Subject: analysis of the performance. Analysis of the performance and position of nevi. So I've told you that in writing a report, you start with introduction. As requested. No, you have been requested. As requested, we have analyzed the performance and position of nevi for the year ended. The year end of the organization is 30th of June 20XY. 30th June 20XY. So, find the attached appendix to this report. So now you may write your introduction whichever way you like. So this is introduction. Then the next one is the body of the report. The body of the report. So we want to start with the performance. Performance. We want to analyze the performance of Neville PLC. On the basis of that, we want to start with the profitability ratios. Profitability. So we want to discuss the profitability. I've told you that the performance is all about profitability. Profitability ratios are used to measure the level of the performance of an organization. If you look at the revenue between 20X4 and 20X5 increases by 20%. The revenue increased by 20%. The revenue of Levi, the revenue of Nevi increased by 20% between 20X4 and 20X5 financial years. Revenue increased by 20% between 20X4 and 20X5 financial year. And it will therefore appear that the strategy of cutting prices and a steady credit has attracted more customers. It therefore appears that the strategies of cutting prices and extending credit is successful. If you look at the rows, I've told you that one of the indices for measuring the performance is the return on capital employed. I've told you that to comment on capital employed, there are two variables you will need to look into. Number one is the profit margin. And the second one, number one is the profit margin, the second one is asset turnover. Asset turnover is revenue over capital employed. So, what happens to the ROS? We want to discuss that. ROS was 48% in 20x0, and it reduces from 48% to 25.4%. That is to show that the performance of Neville is worst off. So in interpreting that, I've told you that you have to look into the probable causes for the worsening in the performance of Neville. So the operating performance of Neville is worst off when measured with the significant drop in return of capital employed from 48.0% in 20x4 to 25.4%. 25.4% in 20x5. We have been able to ascertain that their performance was worse off. And the reason why we have been able to deduce that is as a result of a sharp drop in ROS. I've told you that the ROS for 20x5 will be affected by the wrong figure we have used from the question. But nevertheless, so I will still interpret the results of my computation the same way. So if you use the correct figure, instead of 161,600, if you have used 61,600, you'll be able to get the correct figures to use. So I've told you that to comment on ROS, there are two variables that you have to look into. One is the operating profit margin, and the second one is the asset turnover. Now let's look at the operating profit margin. Operating profit margin. What happened to the operating profit margin of Neville? The operating profit margin in 20x4 was 20.3%, which has dropped to 12.9% in 20x5. So the declined in ROS might be attributed to a sharp drop in operating profit margin from That of the operating profit margin 20x4 was 20.3%. From 20.3% in 20x4 to 12.9% in 20x5. I've told you that to comment on rows, there are two things to look into. You only, by commenting on the operating profit margin, then you've not talked about the asset turnover. You have to strike the balance by commenting on both the operating profit margin and the asset turnover. So, what is our asset turnover? Since I have not completed our asset turnover, let me add that here. Asset turnover is revenue over capital employed. Let me add that. Asset turnover, assets turnover, which is revenue over capital employed. For this, the more frequent you turn over your asset. By turning over the asset, we mean the utilization of the asset. The higher the rows. And when the assets are efficiently used or utilized, the rows is bound to increase. So, asset turnover, I've told you, it measures how efficient the organization are in utilization of their assets. So, revenue for 20x4 is 1,159,850 over capital employed. And we say capital employed for 20x4 is 490,520. 490,520. And that of X5, the revenue for 20x5 is 1,391,820. 1,391,820 over capital employed. The capital employed is 707,765. 707,765. Therefore, assets turnover. And that will be 1,159,850 divided by 490,520. And that will give us 2.4 times. And this is 1,391,820 divided by 707,765. And that will give us 1.9, 2.0 times. Since the asset turnover has declined, that means the assets are not efficiently used. Another reason that might be attributed to the decline in rows. To the decline in rows is a drop in assets turnover from 2.4 times in 20x4 to 2.0 times in 20x5. The fall in asset turnover is an indication. It's an indication that the assets are not efficiently used. Now, we've commented on the rules, the asset turnover, and the operating profit margin. Remember, there is a byproduct of the operating profit margin, which is gross profit margin. The gross profit margin is a byproduct of the operating profit margin. So that means you can assess your operating profit margin. The gross profit margin, it fell from 35.0% to 24.5%. So, furthermore, the drop in the operating performance of nearby might also be attributed to the drop of gross profit margin from 35.0% in 20x5 to 24.5%. 20x4 to 24.5% in 20x5. Then you want to investigate the probable reason for this falling in gross profit margin. The fall in gross profit margin may be likened to an increase in cost of sales by 39.5%. The fall in gross profit margin may be likened to an increase in costs of sales by 39.5% between 20x4 and 20x5 financial years. May be likened. I've told you that Operating performance of Never might also be attributed to the drop of gross profit margin from 35.0% in 20X4 to 24.5% in 20X5. The fall in gross profit margin may be likened to an increase in cost of sales by 39.5% between 20X4 and 20X5 financial year. So, position. We want to evaluate the position of Never. So, number one, we want to look at the liquidity position or liquidity ratio. Let's start with the current ratio. If you look at the current ratio, it was 1.6, ratio of 1.6 to 1 in 20S4. And it declined or it fell to 1.2 to 1. That means the liquidity position of Never has worsened. So, the liquidity position of Never has worsened between 20X4 and 20X5 financial years, when measured with the drop in current ratio from 1.6 to 1 in 20X4 to 1.2 to 1 in 20X5. The current ratios between, the current ratio in both years could not meet the acceptable threshold of 2 to 1 in both financial years. Another reason that can be attributable to the decline in the liquidity position of the company might be attributed to, if you check the quick ratio, it's equally dropped. Though the quick ratio was able to meet the threshold of ratio of 1 to 1 between both years. So you can as well comment about the liquidity ratios. But look at the receivable collection period. It increases from 65 days to 110 days. might be attributed to an increase in the receivable collection periods from 65 days to 110 days. Between both, between 20x4 and 20x5 financial years. This is an indication that the credit policy of Nevi is very poor. Their credit policy is poor, so it needs to be reviewed. I'm only giving you a hint on how to write report. Furthermore, if you look at your payable payment period, it increases from 87 days to 103 days. Furthermore, an increase in payable payment period from 87 days to 103 days. Is also an indication for the liquidity problems. As a result of the delay in payment, delay in paying the suppliers. The suppliers will not be willing to extend future credit to Nevi. Okay, the suppliers will not be willing to extend future credit to Nevi. That is liquidity position of Nevi. Then you also comment about the position of their gearing. If you look at their gearing ratio, it increases from 16.9% to 22.8%, which is also within the scope, acceptable scope. The gearing is not too high. I've told you that when a gearing level of 50% is said to be low. And a daring level of exactly 50% is neutral. And when it is above 50%, it is high. So, since their daring is not too high, that means their financial risk is not high also. So, nearby level financial risk. Nearby financial risk exposure is moderate. Their level of gearing is low. I can still write further. We can still further our discussion. Can discuss. I've told you the implications of a highly geared and a lowly geared. So you comment on that and you discuss that. So I've just given you the hint on how to write an acceptable report.